Okay, this is part 2 of the 6th review before the meeting. We've mentioned several times the bingo signal as a signal of baby out with the bathwater. You look for this as a sign of capitulation in a bear market. A bingo by itself is not an all clear sign. A bingo could be one of many bingos, as we saw in 2007 and 2008. What we look for following the bingo is a series of bullish signals called Eurekas, which we'll introduce to you next, that when I see several Eurekas, I see a kahuna maybe, I see a bullish candlestick pattern. Oh, boy, Bradley, you're wonderful with that recording. Okay. And I know that it's the end. Bradley, if you've got the new version, and this is for anybody, Snagit and Camtasia are great programs, but in Snagit now, in version 12, they have this feature where if you can actually record and if you can save it as an MP4 and you don't have to do anything with it. And when you start a new capture, it gives you a choice of a picture or a movie recording. It's a great product. So bingo, baby out with the bathwater. So Brad, when you finish yours, just stick it in the Dropbox and then everybody will get it. Appreciate that. So we've got our bingo. What about the Eureka? So again, remember, all right, Brad, I'll email you afterwards. It's easy. All you got to do is copy it to the Dropbox, paste it, and you're done. Eureka signal. This is our version of O'Neill's follow-through day. It can be a signal that the end is near. And by that I mean if we get a blow-off top, tomorrow some good news comes out of Iraq, Iran and Israel agree to never hurt each other again, and the world is a safer, happier place. And oh, by the way, the Fed threads the needle and doesn't screw us up. And we see the market shoot up to S&P of 2100. That will be a blow-off top. I can assure you, you will start to see Eurekas. Eurekas at the end of a strong rally are a sign that the market is getting tired. A Eureka after a sell-off is a sign that it's time to jump back in. Here's the calculations. It's changed over time based upon the change in volatility in the market. It brings in a lot of the stuff of Richard Arms, his Arms Index, advanced decline ratios, etc. We have also changed the calculation to be used on the NASDAQ. We may go back to the NYSE, but the NYSE has got a lot of crap in it. And with the new vendor for HGSI bar chart, they're more inclusive. There's a lot of bond funds, preferred instruments, things that we didn't have before, and we think that the NASDAQ, at least now, is a cleaner index. So in my charts, I've changed the index to use to NASDAQ. So you can read about what causes it. This is a strong Eureka. Eureka equals follow-through day. Happy days. We've had that move up. We've paused, and it's different this time, and the market's falling. When you start to see phoenixes, you will recognize that the market is turning down. A phoenix is basically a follow-through day to the downside. Again, you can see the numbers here. We don't get many phoenixes. You may want to do your own adjusting as defined on the bottom by Ian. But I look first, chart of the day, to see whether I've had a Eureka or a Phoenix. And again, we've now switched it to using the NASDAQ. So if you think back to my charts that you've seen over the last year, I have two volume bars on the bottom. The bottom volume bar also has the kahunas. The second to the bottom, or above the bottom bar, has Phoenixes and Eurekas. Please remember this. Put it somewhere in your head and don't forget it. Phoenixes and Eurekas are calculated only on the major market index. I have them showing up on every stock chart, but it never changes unless I look at the next day and there's a new one. And I do that because I'm able to look down and see if there's been anything happening in the market, so I don't go long when I've had two Phoenixes in a row. So it's a great filter for me of telling me it's okay to go in a specific direction. You know, for Marilyn and Bradley and Raj, the ones that are relatively new to us, I can assure you these are what kills people at the PV meeting. When we start talking kahunas and eurekas and phoenixes and bingos and bongos and bangos, it's gone. And that's why I want this meeting to be different. I want you to be able to test you when you get there, not that I will, at least not intentionally, and that you'll know what we're talking about. Now let's switch to another master, and let's talk about John Bollinger. Tell you an interesting story I learned about John Bollinger. Couple of things. Actually, I've met John, a nice guy. His wife is even nicer, which actually is it's the same in my case and a lot of other TA guys that I meet. We all know what Bollinger Bands are. They're bands that are based upon volatility that constrict and expand around the price charts, and they become standard in every charting system known to man. So here's the first anecdote. Bollinger thought up the idea, and apparently Gregory Morris, Murphy Morris, and before that CompuTrack, a market technician, he developed the bands and needed a name for them, and since John gave him the idea, he called them the Bollinger Bands. The other thing that is even more interesting is after one of my recent programs, I think it was a Sunday program, it may have been one of these, I believe one of you came back to me and said, oh, is that where John got the recent changes in his product? Absolutely. Ian's been teaching John Bollinger for several years how to get more out of Bollinger Bands. So kind of interesting. And I know Ian and John are very close and that they had lunch together this past week. So if you think about Bollinger Bands, you're going to capture about 90% of the time. This is your bell-shaped curve. Here's the midline. If you go out two standard deviations, and I guess the reason why it's 90, not 95, as I was taught, was because of it's non-linear, you'll capture about 90% of the movement of a stock or an index. And then as I talk about on my weekend reviews all the time, only about 5.5% of the time will a stock or an index be above the Bollinger Band, and 5.5% of the time will it be below the Bollinger Band. So I'm sort of a simple guy. If I spend 90% of the time within the bands, if I'm below or above the bands, I'm coming back in. And so as Ian put the star there, you make your most money at the extremes. It's getting in and knowing when to get out. And I'm going to put maybe on the get out. So a couple of things that we then utilize out of those Bollinger Bands. So as you look at this cup, what I want you to visualize, upper Bollinger Band, lower Bollinger Band, middle of the band. In a bull market, one would expect the majority of the stocks to be bouncing between the upper band and the middle in a channel. In a bearish market, you'd expect it to be bouncing between the middle and the lower band. So one way of putting a number on a market to help determine whether it's a bullish or a bearish market is, are more stocks above the middle or below the middle? So one of the things that I look at in Edge Rater every week, every night actually, is how many bars are above in green or stocks are below in red. And I look, when it's 70 to 80, that's a very bullish market. When it's 20 to 30, it's bearish. The other thing that we've learned from Bollinger is percent B. And if somebody tells me that percent B is at 0.4, I know it's right, the stock closed right below the midline of the Bollinger Bands. If it's at 1.0, I'm at the upper band. So percent B is a wonderful thing for understanding where a stock closed or currently sits within the Bollinger Bands. Ian did research, and Ron, and found that if you get a movement of percent B of 0.24, that's an interesting day. It's unusual, and it's a pay attention. If you get a move of 0.4, that's a very unusual day and probably demonstrates institutional buying and something is going on in your stock. So I screen for kahunas as a sign that my stock has somebody caring about it besides me. Now, within Edge Rater, we also harness percent B, and we look at the market by looking at percent change B in the market over time. And we'll look at my market view out of Edge Rater that you all can have if you have Edge Rater, based upon changes in percent B. And when you get 4 buckets skipping, each bucket is 10%. When a market moves more than 4 buckets in percent B, that's a heads up that something's going on in that market. And we'll go much more into this when we're live. I call it bucketology. This was June 6th. 88% were green. 30% were above the upper band. This is each decile between the bottom 0, first 10, second 10, third 10. Greater than 1 is above, less than 1 is below. And we see that 30% of the stocks were above the Bollinger Band. And we actually had a couple of days of pulling back at that point. Here's what a preceding low looked like on April 11th. And this is when I make my comment that I call this bottom. Over 30% were below the lower band. 86% is a big number. And then this was the prior up, 89%. And you can see the stocks congregating. I learned so much from these charts, and I hope that you'll learn the same at the meeting. So I'm a very trustworthy guy to a point. And when someone says to me, you know, when it gets like this, be worried about the market pulling back. When it gets like this, be worrying about a bottom. So I've done a short analysis. Again, no one commented on this, which sort of surprised me. On one of my videos. This is good work. It's not good enough because I've got to go back now and look at bear markets. And the problem is the S&P 1500 components will change. So it's possible that I won't know the exact S&P 1500 in 2001 and 2005. But I've got the data, and I'm hoping to get this done shortly and then maybe write something up and maybe partner with somebody and get it published, because I think this is interesting data. You notice the red bars here. These red bars represent the largest skew to the left, the largest number of stocks below the Bollinger Band in this uptrend. Every one of them signaled within 3 days a reversal in the market. So this is my April 14th webinar, or April 11th, or 12th, or 13th. I got pretty cocky. This was doom and gloom weekend. Tax time. It's horrible. The market's horrible. And that's why I did this analysis. And if you go back and play back my video, I said within 3 days, this market will correct to the upside. And that was the low of the market, by the way, on this cycle. We use a, we use the market ebb and flow, and I'm not going to spend much time on this. Yep, everybody's got great comments here, and I agree with them. Combining different things. The market ebb and flow takes the major indices, and this is looking for kahunas, and whatever reason, the blue came out gray. This is the percent B, and Ian's helped us define above 0.7 is green, below 0.3 is red, in the middle is yellow. Gives you a sense of where the indexes are. So for example, when I did this on June 6th, and I did this, I believe, right before I spoke at the Palm Beach Traders Group, I told them market's probably going to pull back for a couple of days because each of these indexes, percent B was above 1 or very close. But I also said I think that we're in a bull, that the bull market is back, and that we're still in an up, that the uptrend is here. And if you look at last weekend's, you know that we got a bunch more green over the last week. So this is ebb and flow of the market. This is bandwidth. God only knows how they calculate that, but how wide the Bollinger Bands are. And this is percent B times bandwidth. And Ian does a much better job of me of explaining it. I just know how to use it. So I combine my buckets, I combine this, and I combine my high jump, and I got my timing model. And hopefully you'll get comfortable and figure out what your timing model is by using these tools. May the force be with you, Alexander Elder. There's a picture now of Elder and Carrie, because about a month ago I spent the weekend on Mother's Day. Someone's got to buy technicians' calendars. John Persons has his over Father's Day. Alexander Elder has his over Mother's Day. But y'all who watch us, I think, have learned that we're very excited by the 2-day and the 13-day force, that the 13-day force is long, is green in an uptrend or positive in an uptrend. The 2-day force is much quicker moving, and we'll see from time to time the 2-day force go red or negative in a pullback. So you can, these are different systems. Excuse me, that are defined. Here's a website by John Sarkit. of how he uses force as a trading tool, a system in trading rules. And we'll look at these. And by the way, Ron Brown has built every one of these rules into HGSI. So many years ago, after we all got so excited by the bingo, which was developed by Ian and Ron, Ian looked at several of us, myself included, and said, now it's your turn. Go and develop a market timing model to signal entries and exits in markets, industry groups, and stocks. And you know, it was probably some of the most fun I ever had. Dave Steckler, Dave Ghilardi, myself, I think Manu, Bob Meager, I think Robert Minkowski may have been involved. It's been so long I can't even remember who the whole group was. Maybe Steve Cole. So we had calls every week. We all had different ideas. We then came to an agreement of what our indicator would be, back tested it, determined that it worked, and then it got incorporated into HGSI. And what we defined the bongo as a tool that looks at four things, which are really two things. It looks at the Wilder RSI. So if you think about relative strength to O'Neill, or in the ERG calculation, is you're comparing the strength of a specific instrument to all the other instruments that you can compare in your library. Wilder RSI looks at the strength of an instrument compared to that instrument in the past. So it has nothing to do with anything except the instrument you're looking for. So we played around, back tested, optimized, and we decided that to turn yes on the bongo, the Wilder 8 RSI had to be above the 14 and had to be above the 19 at the same time that the price closed above the 9-day simple moving average. To have a bongo no criteria, it was just the opposite. The 8 was below the 14, was below the 19, and price was below the 9. Once you trigger a yes, it stays a yes until both these criteria occur at the same time. I use these as a filter. What do I mean by that? I mean that similar to the force, the weekly bongo stays green for the majority of an uptrend. That the daily bongo will go red during a pullback. So if I'm looking for a pullback, then it might make sense for me to look for a bongo green weekly and a bongo red daily. I also use it as a filter that says I better be careful going long when the weekly bongo is no, because that tells me I'm going against the trend. Now, if you think about a uptrend turning into a downtrend and months later becoming an uptrend, that means you're going to miss the beginning of every trend. You'll be late in and a little late out. My goal was to create an indicator where I would capture the majority of the trend and not lose. I use this as a filter, meaning take the trade or not take the trade. I scan to see things that are still uptrend by weekly and have gone red by daily to look for pullbacks. And I know that Dave Steckler, who's an ETF trader, I don't know if he's still using it, but he used the weekly bongo as a market timing tool for quite some time with some success trading ETFs. So I guess this is the holy grail of where my charts used to look like. And the holy grail was, I got my Hindenburg up here. The data source changed, and I have a fix for it now, but they weren't firing on with that data source, so I ignore the Hindenburg here. The charts I made earlier were before we changed to bar charts. We've got some fixes we've done, and you can see that I went back in time with the current data, because you can see the little gray bar here. This is a much more current chart than back in 2009. I've got my Bongo weekly on top of my Bongo daily. My uptrend started about here. My Bongo weekly went green right away, but every time there was a little pullback, it may have got me out of the market. Yet once my Bongo green went green on the weekly, it stayed green for a long time. You think about grandma managing an ETF fund who really doesn't have time to watch the market and understand all the mumbo jumbo. It got her out in June of 2008, got her back in falsely with a false recovery here in the beginning of 2009, and then got her back out a couple weeks before the bottom, before the bingos, and got grandma back in when it went through the 50 in late March. I would argue strongly that the weekly Bongo is a much better timing mechanism than 99% of personal individual trainers use. And it's simple. We spent a lot of time on Mobo, and my voice is going, so I'm not going to spend a whole lot of time on it. This is David Elliott. Part of what I want to do at the meeting is do a little vignettes of each of the masters that I follow, what I learned from them, what works, how I incorporate it. And this is the Mobo, and basically the story about Mobo is Bollinger Bands do not tell you when to buy and sell. That David Elliott, may rest in peace, created a new indicator, a new type of a band called a Mobo band, and all he did was he varied the formula on a Bollinger Band as far as as a multiplier effect. So he creates a band that is inside the Bollinger Band, and when you trade below that band, that is a Mobo breakdown. When you trade above that band, it's a Mobo breakout. And in the context of a squeeze, I find this to be a very compelling. Now, blue is the Bollinger Band, green is the Mobo. One of the greens is a moving average. This light green is the midline. And so you're looking for a stock in a squeeze that does, here's a Mobo breakout above that band. Too hard for me. So I could paint those, or I could do other things in your charts. So and there's the rules for Mobo. One of the very beautiful things about HGSI is we programmed in the Mobo breakouts. There are some variances that you can put in to change some of the multipliers if you prefer. But Mobo is built into HGSI. I'm a big fan of the squeeze. Perhaps brought to us by John Carter. There are debates about who developed it. I don't really care. The squeeze that I use is kind of the purest definition. A squeeze is a volatility play which combines Bollinger Bands and Keltner channels. And the squeeze, Apparently Centers is the marketer, and so I think maybe it come from elsewhere, but who knows, and I don't want to get into that legal quagmire. But a squeeze indicator identifies periods of contracting volatility, and a squeeze occurs when the Bollinger Bands contract inside the Keltner channels. So here is that same chart I did over here. And what I did is I painted every time it's in a squeeze, and I moved the breakouts above. And then if you think about how I trade today, and I'll show you the new chart in a second, I like to buy breakouts from a squeeze. I'm also, I don't think I've got wild, well, maybe I do. Let's see if Wilder PSAR comes up. If not, I'll talk about it. Those that have bought my indicators will someday realize they got a bargain if they actually buy anybody else's indicators. I've got the red candle highs and green candle lows. I got the pocket pivots. I got the MOBOs, the squeeze, and the Bible gap ups all coded for you. I didn't realize I gave it to the first person, so I left it in. I also have the high jump. You can scan for these in TradeStation or Thinkorswim. Everybody has the Thinkorswim scans if you're coming to my meeting. You just don't know where they are. Seasonality, I will review in the meeting. I'm a huge believer and a huge fan of seasonality. I have a calendar built that includes the big winners to remind me when it's time to do them. When I make my weekly picks, I run them against Magenta. And I like Magenta Trader because it's a combination of seasonality and range trading. And I frequently screen the market with Magenta to find stocks that I haven't seen before that I might want to look at. So we're going to look at seasonality during the meeting. And since I don't work for Magenta or Best Choice or TradeMiner and now EdgeRater, I will give you honest pros and cons about each product before you go spend $5,000. You all know about this. You know about how I think you need to become your own guru. Make sure you got the right tools. If you're listening to this, you know about education. But the most important message I always give is to trade the market we have, not the one you think we should have. One of the indicators that I forgot to put in tonight is the PSAR. So the PSAR is, let me just open up a chart. It's also from Wells Wilder. And the PSAR, oh, this is when we developed last time. Imagine that. Someone made a comment, am I recommending Wise Trade? I hate to admit it, that not only did I at one point have Wise Trade, I also spent like $10,000 and bought Command Trade. I was an idiot. I know I wasn't the only one. Best marketing company known to man. The PSAR are these dots. They stand for parabolic, stop, and reverse. Wells Wilder developed them. They can be used many different ways, including, what am I looking for? Including as a trading system. You can adjust acceleration and max acceleration. I have no idea what it'll do to you, but it changes how close the dots are to the price and therefore will change how frequently the PSAR flips. There are people in this world that make money by going long when the PSAR goes below the price and going short when the PSAR prints above the price. I kind of like when we start to put a lot of these things together. I think it's a very supportive thing to my decisions. But what I like about the PSAR is this. All securities, I've got my $2 and 150,000 shares on, and I'm working on your filter, so you'll have everything when you get there. In the entire universe of stocks, these are the stocks that right now are squeezing, and the price is right beneath the PSAR. So, if I was looking for potential stocks to go long on, all right, IPHI, INFI, I don't know if this, Inophos, is this, who knows what this, I think this might be an inorganic phosphate company. Let's see. No, this is semiconductor. That one's IPHOS. All right, semiconductors are hot right now. So what do I have here? I have a stock with no volume, so I'm probably skipping it. Let's look at 200,000 shares, so it's not no volume. Doesn't make any money. I don't like that. So that's not good. It's kind of been in a downtrend. It looks like it's only been around for a short period of time. But what I do like is the stock's been in a squeeze since May. Whomever asked the question, will we be able to measure days since squeeze? It's in the update that came out Sunday. So yes, that is now in the program. I'm squeezing. I just had 2 Mobo breakouts from a squeeze. I had a big kahuna yesterday, and my price is sitting right underneath the PSAR dot. This is one that I might consider looking at further because it's at some type of a support. It's squeezing, and it's about to have a PSAR flip. ICE, I don't like it because it's below the 200. On the other hand, it was an uptrend, pretty deep pullback. You see how close it is to the PSAR dot? Moves up a little bit, it's going to get above the 50. The dot will be support and turn green. It's an Mobo breakout from a squeeze. Next, Terra Energy, uptrend, pullback to the 50. Pocket pivots galore, kahunas, squeezing, Mobo breakout. If this wasn't a utility, I'd be excited. So the point here is there is no other program that you could do one button and bring these up. And I hope as part of the See One, Do One, Teach One, you're going to make your own, and you're going to be sending me things because you're so excited because you found great tools and you want to show off to me, which means I make more money, so keep doing that. I could look for the volume buzz, etc. I did want to show you today my new charting tool. And I want to introduce you to something new. Probably not a good choice there. Let's just go pick something let's pick URI, United Rentals. They got downgraded today. My protective put's at 100. I own a shitload of this stock, and I've been in the stock from way to the left, even before here. Introduce you right now to the new chart. So what you're going to do is you're going to go on the Choose Create View. You're going to left mouse click. You're going to highlight wherever you want to highlight. I'm going to put it in my views. You're going to go to Import. You're going to go to Dropbox. You're going to get your Dropbox. You're going to see OBV added, and you've imported it. Let me show you what I did today. I took out my second volume window because you know what? Volume doesn't work anymore. There's never any volume. There's dark pools. There's options. I need something better. And one of the things that John Person will teach you is the power of unbalanced volume. So I added that to the window that has the Eureka and the Phoenix. Here's my new chart. And what I've been taught not to look for is look for positive divergences between price and convergences between price and the unbalanced volume, which is down here. And also look for when price drops below unbalanced volume, it might be an early sign or above early warning sign to get in and get out. He gave a number of examples, and I walked out of that meeting saying, shit, that's what that thing does. I think unbalanced volume, and I'm trying to figure out some of the examples he showed us. I think unbalanced volume is incredible, and I think you're going to find out it's very useful as well. Here's gold. So unbalanced volume crossed above its moving average right there. And there were a lot of people that were out there saying to buy gold. You notice the kahunas, or the pocket pivots rather, and the kahunas. He went long gold on his unbalanced volume here. It doesn't break the red line, the moving average, until here. Wouldn't that have been a nice place to have gotten smart and gotten out of gold? Unbalanced volume, as the way he taught it to me, really opened my eyes. So guess what's part of my charts, folks? I'm a believer. And so he'll go over some of his great examples of how he uses unbalanced value at the meeting. So on that note, I think I've gone probably my hour and a half. Any questions that people have about the HGSI vocabulary and the tools? If it's still whizzing over your head, welcome to the team. I've only been doing this for 20 years, and I'm still learning things. I'm embarrassed that many of you still haven't finished the Excel spreadsheet. I'm sending it out one more time tonight, and a request for people to fill it in, and then I'll collate them and send them out again, the final one that I have on Wednesday. I already did one setup for carpooling. We're going to have a great time. You're going to gain weight. You're going to get some great networking. John Person will be at the meeting, at least on Sunday. He will be at dinner on Saturday and Sunday. Great guy. And I will, just seeing the questions that came in, I am going to put all the movies in the Dropbox for the new people so they don't have to worry where they are. I will put each of the 5 PowerPoints in the Dropbox because I don't think I put them in the beginning. Just to point out, I don't always tell you when I put something there. That's a mistake. And you guys have done good. No one's taken things out yet. Last week, I put this presentation in the Dropbox. Okay. A couple of weeks ago, I did something which is risky, and I put my buy watch in on Sunday. Because if I suck, I lose all my credibility. All right? Here's what I do. I create lists based upon why I'm buying them or why I'm interested in them. Breakouts, leaders, pullbacks ready to run, waiting for a signal, bottom fishing, and then special situations, which are usually yield related. And then in my lovely trade station, and I haven't done it yet for this week because I was traveling. I then fill them all out under the heading, and then each day I see which stocks are working the best. Turns out that they don't all work at the same time. Sometimes it's bottom fishing, sometimes it's breakouts and leaders. So the other thing that I got to tell you that's really neat is, and why do I go to meetings? Because I don't care how much I read, I always learn. So I was at Person's meeting, and John has these buy test signals, and I run them every night, and I look at a lot of the stocks, and they make me money. And by the way, if you have Thinkorswim, you have his buy signals because he puts them in there for everybody. I was able then to take my mega list instead of just the S&P 500, and I created some big lists. And the amazing thing is, when I went and looked at charts and found the charts that really made sense to me, I was amazed at how many of them had Person's signals firing on the same day. So there's and we talked about it yesterday. We were hanging out for a while in LA, non-correlated, but it was very interesting. So I'm going to teach you about a lot of the things that I do. I'll make you better at HGSI. You already are better because of these 6 sessions. Appreciate everybody's involvement. The other thing I wanted to show you in the Dropbox is, let me close this. If you have Thinkorswim, here are all the different indicators. Pocket pivots, high jumps, Bible gap ups, bingos, kahunas. All right. And if you don't know how to import them, I'll get them in. I'll send out the start times. I think breakfast is ready at 8 rather. I'll be down there at 7 or 7:30 setting up. We'll start between 8:30 and 9 when everybody gets there. But I put some goodies in the Dropbox, and then typically for the next 90 days, you're my best friends because you gave me money. I really take it serious when actually somebody gives me money for teaching. I'll continue to populate your box with other things that I find interesting. You've already got Bob's update for October, which, as you can figure, isn't October yet. So we got some good things to give you for that as well. And I look forward to seeing you. So as long as you're down by 8, you'll be fine. Prepare to gain weight. And then for the people that are coming, not to be a hard ass, if your spouse is coming for dinner on Sunday, we're thrilled. We love it. We welcome her. Bring me a check for $85 because that was, and other than that, we're in business. It doesn't have to be married. It could be your whatever. We'll see you soon, guys. Thanks, everybody. So I'm not going to end the conference yet because I got to walk Brad through saving the movie. Brad, stop the recording. I think you should hit Shift F10. And I'm going to stop mine just in case.